Hi, good afternoon, everyone. This is Ian Gendler. I'm the Director of Research here at Value Line. Let's get started. Today, I'm going to take you through the investor tools that are offered to digital subscribers of the Value Line Investment Survey. They are the Screener, Watchlist, and Alerts Hub. Utilizing these tools, along with Value Line's entire suite of data and analysis, can greatly speed up your investment decision-making process, as well as help you reach and hopefully exceed your investment goals. Once again, if you have questions, please type them into the Q&A box and I will answer them at the end. Also, after this presentation, we will be posting it on Value Line's YouTube channel if you'd like to consult it later. Value Line's database includes information, estimates, projections, proprietary ranks and ratings, and analysis on 6,000 stocks that trade on North American exchanges. The screener will allow you to quickly focus on only the equities that meet your specific investment criteria and strategy. The watch list enables you to easily keep track of the stocks you already own, as well as issues that you are monitoring for possible purchase. It is also very helpful for evaluating a small group of stocks side by side. Lastly, the Alerts Hub will keep you up to date in regard to the stocks you are following. Via email or text message, you can be notified when a noteworthy event occurs that affects a stock that you are following. Before I dive in, I do want to provide some background information on Value Line. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis of more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including the 1,700 that are included in this service. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional security analysts are not permitted to own shares of any company that they cover. I mentioned that the product includes economic and stock market commentary. As all of you surely know, after a multi-month rally in the market following November's presidential election, there has been some modest profit-taking and increased volatility of late, and I want to take this opportunity to discuss Value Line's view of the current environment. The following was prepared by Harvey Katz, our chief economist and managing editor. The industrial sector was continuing to hold its own as we entered the second quarter, with recent data affirming that manufacturing output was up 0.5% in February for a second month in a row. In all, this was the sixth consecutive monthly gain for industrial production. Also, factory usage in the manufacturing area rose last month, edging further above 75% of capacity. Importantly, utilization remains below the levels that would imply an inflationary bottleneck in production. The consumer also is showing resilience, with housing starts and building permits on single-family properties ticking higher in February. In all, the public, optimistic due to rising home values and better job opportunities, continues to retain the sentiment needed to keep spending at healthy levels. So the business beat should pick up as we get closer to mid-year. On point, after an unimposing start to 2017, we would expect growth to accelerate in the second quarter, with GDP gaining well over 2% for the period. A late winter surge in the leading economic indicators also points to the staying power of the expansion. Still, we think the Federal Reserve will remain accommodative in its monetary approach, opting to just slowly raise interest rates. All told, the Fed, which lifted borrowing costs in mid-March, may vote in 2 additional rate hikes this year and 3 more in 2018, when the economy will, presumably, be growing at a faster pace, especially if tax cuts and new spending initiatives are adopted. Things are going less smoothly between Congress and the White House. Due to a lack of support in the House of Representatives, the initiative to repeal and replace the Affordable Care Act has been shelved, and President Trump has now turned his focus to tax reform. However, the roadblock in the House has raised doubts as to whether a major tax plan can be passed, at least by the end of the year. Not surprisingly, market volatility is on the rise, with the equity indexes experiencing recent wide swings as sentiment waxes and wanes, in large part on the ebb and flow of news out of Washington. Meanwhile, even as the averages still are near record levels, challenges remain, most notably in the areas of legislative reform, global dealings, and the upcoming earnings reporting season. In conclusion, the biggest challenges are the elevated PE ratios, which leave little room for disappointments or missteps. I'm now going to begin the core section of this presentation and start with the screener. To access this tool and the others that I will discuss today, I must first sign in with my username and password. After entering from my credentials, I am taken to a welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head directly to the Investor Tools, and as mentioned, I'm going to proceed to the screener. Please note that the tools can also be accessed via the Find Ideas tab at the top of our website. Individual subscribers are entitled to a number of Value Line preset screens, as well as 50 data fields. Please note, however, that almost 200 more fields are available, but require a higher level of subscription. If this is something that interests you, please call 1-800-VALUE LINE to speak to your account representative. For this exercise, my focus will be a popular investment strategy, which should interest many of you on the call today. More specifically, I'm going to look for conservative, income-generating stocks that are also highly valued by many of Value Line's proprietary ranks and ratings. Let's start with the dividend yield. At present, the median of estimated dividend yields of all dividend-paying stocks under review in the Value Line Investment Survey is 2%. This figure is updated and published each week on the front cover of the summary index. Income investors are likely going to prefer to own stocks that offer yields that are comfortably ahead of this median, so I'm going to start with 4% as the minimum. As you can see, 434 stocks meet that criteria. Of course, that is far too many, so I'm going to narrow it down by utilizing some of Value Line's proprietary ranks. I mentioned that I want to focus on conservative stocks. Thus, utilizing Value Line safety ranks is greatly recommended. Value Line safety ranks measure the total risk of a stock and is arranged on an easy-to-understand scale of 1 to 5, with 1 buying the least risky issues. For this, let's focus on stocks that have above-average risk profiles. So I click on the green 1 and 2, down to 44 stocks, which is still a few too many. As Harvey Katz mentioned in the economic and stock market commentary that I read earlier, the biggest challenges are the elevated PEs, which leave little room for disappointments or missteps. Let's incorporate that thinking into this screen. Also on the front cover of the weekly summary index is the median of estimated price-to-earnings ratios of all stocks with earnings. This week, that figure is 19.4. For comparison purposes, that metric was only 10.3 in March of 2009 when the market hit bottom during the Great Recession. So let's only look at stocks with current PEs below 19.4. That cuts our list in half to 22. Lastly, I want to make sure that the results only include companies whose businesses are growing at a decent pace, at the very least. For this, I'm going to utilize Value Line's proprietary financial estimates, which are created in-house by our team of professional securities analysts. The estimates of sales, earnings, net profit margins, income taxes, and so forth are all devised from spreadsheets maintained on every company and are constantly updated. I want to focus on the expected advance of annual earnings, so I select the field projected 3 to 5 year EPS growth rate. And I'm going to set the lower bound at 5%. Well, that worked, and I'm left with just 6 stocks. Conservative income-seeking investors are encouraged to evaluate these issues. Perhaps one or more of them would make a fine addition to your portfolio. However, let's say I am not ready or available to look at these further, but definitely want to revisit these selections. I can, of course, save this screen, but this is also where the Watchlist tool comes into play. Let's go there now and set up a new watch list. I'm going to name it Income Stocks. And all I need to do now is just add the tickers one by one. Now I can evaluate these stocks side by side, as well as easily get to the full reports simply by clicking on the company name. For this hypothetical, let's say that after evaluating these 6 stocks, looking at Value Line's analyst commentaries, projections, ranks, etc., I decide that AT&T is probably the best fit for my portfolio. But I want to monitor the stock for a little while before I take a position. Utilizing the Alerts hub is great for this. You can set up alerts for a variety of events, including when the price of a stock moves considerably or when Value Line changes the rank of a particular equity. In total, more than 25 alert functions are present, and these notifications can be delivered via email and text message. Let's set up an alert. First, type the company name or ticker. That will provide some basic info. Now I want to make sure that I don't miss new Value Line reports for AT&T. So under Analyst Updates, I select Full Analyst Review Available. I then select my email address that I stored, and I click on Add to Alert Subscription. As you can see, the alert is now created, and this will save you a great deal of time when monitoring the stocks that may be of interest. In particular, setting up alerts that notify you when your holdings increase or decrease significantly in value is highly recommended. I hope that you found this presentation helpful and that you will utilize the screener, watchlist, and alerts hub during your investing process. However, for those subscribers that want more direction, I do want to touch on Value Line's model portfolios. Subscribers to the Value Line Investment Survey have access to 5 such portfolios. The first 4 are included in the weekly summary, in the weekly selection and opinion. Each one has a different investment strategy, is actively managed, updated each week, and always contains 20 stocks. The portfolios are overseen by senior research analysts. Portfolio 1 is best suited for aggressive investors and focuses on stocks that are expected to outperform the broader market over the year ahead. Portfolio 2 should be of interest to more conservative investors and focuses on dividend-paying stocks that also offer worthwhile appreciation potential. Portfolio 3 chooses equities with long-term price growth potential and, of course, is best suited for patient investors. Portfolio 4 is filled with stocks that possess above-average dividend yields and is for investors seeking current income. We have a great number of subscribers that follow these portfolios. For those interested in possibly adopting one of these strategies, here are a few helpful details. New positions always amount to 5% of the market value of the respective portfolio at the time of the trade. Any dividends received are simply taken as cash. They are not reinvested. Lastly, the portfolios are not rebalanced. All told, the model portfolios represent some of the Value Line Research Department's best investing ideas, and we recommend that you read the analyst-created content and look over the portfolios for possible additions to your portfolios. VLIS subscribers also receive a weekly email newsletter each Monday morning. This newsletter, which is written by senior research analysts, includes stock highlights, industry analysis, and the fifth model portfolio. The $5 to $15 portfolio, as the name suggests, focuses on stocks that are priced between that range. Just like the 4 model portfolios in the selection and opinion, it is an actively managed 20-stock group. It is also updated each week. If you are a VLI subscriber, please be sure that Value Line has your email address on file so you can receive this valuable newsletter. If you are not receiving the investment research email, please call us at 1-800-VALUE-LINE. Subscribers looking for a total investing solution are also encouraged to check out our monthly stock selection services, Value Line Select, Dividend Income and Growth, and Special Situations. This concludes the formal presentation, and I will now answer your questions. Looks like we have 3. In the screener, how is the dividend yield calculated? It is calculated by taking the current price of the stock and dividing by the next 4 expected quarterly payouts. These estimates come from our analysts and are constantly reviewed and updated. Next question. Why are some of the 1,700 stocks covered by Value Line not ranked? Well, first, all stocks covered always have a safety rank. However, I assume the question is asking about the time when this ranks. Indeed, many of them are unranked. First, to have a rank, a stock must be trading for at least 2 years. For instance, when we initiate coverage of a recent IPO, it will not be ranked for timeliness. In addition, when a company is in the process of being acquired, or rumors that a buyout offer may materialize, we will often remove the rank since the stock is now probably not just trading on fundamentals. If a deal doesn't materialize, we will reinstate the rank. All right, third question. On your one-page reports, how are the annual rates calculated? The answer to that is, since financial results can vary wildly from year to year, we calculate growth rates by utilizing and comparing 3-year base periods. More specifically, at present, our growth rate projections compare the average of 2014 through 2016 with our estimates for the 2020 to 2022 timeframe. We think this provides a more accurate assessment of a company's likely performance. That concludes today's webinar. I want to thank you very, very much for attending. Have a great day.